Well, welcome, ladies and gentlemen. This is your host, Robert Roy. Welcome to Wealth Builders HQ. This evening, I want to talk about something called options basics. Now, I have had numerous conversations in the last few weeks with students where there were some confusion on the basics of options. So I just wanted to put a video out there, cover some of the basics. Now, guys, I know there have been many videos that people have made. There's also many people that are out there talking about trading and really do not have a whole lot of inkling of what they're doing. So I wanted to make sure that you have a place to go to get the right information that is accurate. Since I have trained over 50,000 people on how to trade options, I think I have a fairly good understanding of how they work and how you should utilize them. Now, this will only be the options basics. We will not go into, at this point, the more advanced components. What I mean by that is we're not going to go into technical analysis. We're not going to go very deep into the Greeks. We'll talk about what each of the Greeks are, and then we'll go look at an option chain, and we'll wrap it up from there. It'll be a fairly short video. So let's go ahead and first is talk about bid-ask spread. Now, I realize that that is not an option Greek, or an options component rather, but it is something that has to do with stock and or options. So the bid and the ask are the price that you either buy or sell at. The spread is the difference between the price. So if my option were trading at $1 by $1.05, right? So my bid would be $1, my ask would be 105. What that basically is telling me is I can buy it for one price and sell it for another. And you know what? Let's do it this way. If I bring in a paint here, if we had bid, ask, and then if we put $1, 105. Now I want you to look at those numbers, and if you wanted to buy this, which one would you want to buy it for? Well, obviously you'd want to buy it for the dollar if you had a choice. If you wanted to sell it, which one would you like to sell it for? Well, common sense, Rob, I'd like to sell it for more money, so the $1.05. Okay, good. Here's the way bid-ask spread really works. It's not the way I just said it. The way bid-ask spread really works is look at the price. Which one do you want? You can't have it. Whatever price you want, it's the opposite. I want to buy it at $1. You can't. It's 105. I want to sell it at 105. You can't. It's $1. It's always the opposite of what you're looking for. The difference between those two numbers is called the spread. Now, we don't necessarily go after and want to pay the full $1.05. Now, if you're in a rush, the position's moving, you want in, yes, absolutely. You know, we get into some of the order entry components. We'll do a video on that shortly, on order entry components and management techniques. Then maybe you just want to enter into the trade. Good, $1.05, I'm in. I get it. But if you're not in a rush and you just want to negotiate that number, there's something called the mid price, MID, which is mid. Right? Some brokers will call it the mark. And basically what the mid price is, the software, whoever your trading software is, will determine what that is and tell you that. So I have an option chain here on Caterpillar, and it shows the bid and ask price. Now this is an option that is expiring this week, and we'll talk about how much time we want to look for. But when we look, I'm just going to go with the 113. Right? This has a bid ask of 116 by 123. Now I could start doing math, or I could just say, okay, what's the mid? The mid is 120. So what they're telling me is they're cutting the price in half, and they round up or down. Don't worry about which way it goes. 120 is the current price. So what that says is if I click on that position, then I could go ahead and set up a buy or a sell. And if I just wanted to buy this position, it's single, I could buy that position outright at whatever quantity I wanted to. Here's my mid. Right? So if I click on the mid price, it will give me that mid price. If I wanted to negotiate it, I could negotiate it right here. Oh wait, I went too far. Just hit mid again, and it'll fix it. If I want to go natural, this is what it's on the ask, the natural price for the buy. It's automatic. Mid just helps me not have to do math, all right, which I like a lot. Then let's talk about our first options component is delta. Delta stands for rate of change. And basically what delta tells us is if you have a delta of, I'll make a number up on an option, say it's 80. That means for every dollar the stock moves, the option theoretically should move 80 cents. If you have a delta of 20, for every dollar the stock moves, the option should move 20 cents. If you have a delta of 13, the stock moves $1, the option moves 13 cents. All right, that's theoretically how delta works. The market maker doesn't have to move it that way, but it's a guide to help you understand about how much your option will be worth if the stock moved X. So again, when we get into technical analysis in another video, you'll be able to watch and say, okay, if a stock has $4 to go to resistance, I'm not going to get out all the way at 4, I'm going to get out at 350. If the stock moves 50 cents for every dollar the option move, how much will my option be worth come expiration? That's how delta helps us to understand. Now, it's also a probability calculator. When you look at delta and it says there's a delta of 70, that 70 delta tells me that there is a 70% chance that that option has what is called cash value, or better known as intrinsic value, come expiration day. Right? Expiration day is always the third Friday of the month on a monthly position. Many stocks now, hundreds of them, about 10% of the optionable stocks have weekly expirations on them where they expire every single week. Right? Delta, as far as a range, guys, I look for a 65 to 85 range on my delta, but that's a guide, not a definitive. And what do I mean by that? Well, 65 to 85, but what if I had 62 and then 98? Okay, well, 62 works. I personally prefer to be closer to the 65 than to the 85 for multiple reasons. One of them is cost, sheer cost. Number two, I get a better bang for my buck if I'm good at charting. You need to be good at technical analysis. Guys, as I have taught all these students over the years about technicals, that's the key. I am a technician by trade. It's what I do. I read charts. I do them day in, day out, over and over again. As you become good at reading the charts, you don't need as much safety cushion and going into that higher delta. Closer to that 65 is better because I spend less and have a bigger bang for my buck. I have a 65% chance that the option will have cash value versus an 85% chance if I went with a higher delta, but I'm paying the price for that. So the next component is the open interest. Open interest tells me how many contracts are open right now in somebody's hands. I need a minimum of 100. Don't read anything into it. Just find 100 or greater. What if it's 2,000, Rob? Is that better? 100 is 100. Anything greater than that is fine. If you're looking at Apple, you will almost always have very large open interest. You're looking at Ford, you may have lower open interest. Or, whoever the stock is, Sprint, or it could even be Caterpillar. You may have some lower open interest there. And then lastly is something called Theta. Theta starts with T. T stands for time. Theta is the time value deterioration in an options pricing model. It helps us to understand how options deteriorate. We will not use Theta in our determination for picking an option today, but we will talk about time as far as how long until expiration date. So let me bring us back into an option chain. I'm going to close out the trade that's in here. And let's go ahead. Let me maximize this on the screen. And let's go here. So when we look at our option chain, the very first thing I want to find is the delta range. And this is an option that expires this week. You will have to determine, are you day trading? Then I'm going to take a trade for this week. If I am trading longer term, couple of days, couple of weeks, I want to be out of the trade when there is at least 2 weeks left until expiration. So if you think it's going to take 1 day to get out of the trade, I wouldn't buy this week. I would buy 2.5 weeks, 3 weeks of time. So I would go 3 weeks out and look for my option. Right? That makes sense? If you think it's going to take 4 months, I want to make sure that I buy an option that even when we get the 4 months through, I still have at least 2 weeks left until the expiration date before the option expires. That allows me to not have theta, time value deterioration, become our biggest enemy in our trade. Right? So we look for the delta 65 to 85. Well, I have a 61. I'm not opposed to 61. But I'd rather find something that fits the rule if I can. I have 76, aha, and I have 86. Again, I'm not opposed to it, but we need to check the open interest. There are 308 open contracts right now on the $112 strike price. That's the agreed upon price to buy or sell our stock for, right? And that 308 contracts, 76 delta, both of those are good. So if I liked Caterpillar and I want to just trade it for the day, this is the option that I would consider. Now, is there another one? Yes, there's an 86 delta. It's close enough, right? It will cost me a little bit more money. It'll cost me $2.78 as the mid, but I don't have enough open interest. There's only 38 contracts out there that have been opened. What does that mean? You're going to dance more with the market maker on lower open interest than you will if you have a much higher open interest. So here's Caterpillar. It expires this week, 4 days from now, 3 days from now, and it doesn't even have 100 open interest on it. So you can't read too much into it that every stock will have all the open interest you need. This is just a way of weaning out the bad and having the good rise to the top, basically the cream rising to the top. Okay? That's it, folks. That's what you would do. If you needed further out, if I thought it was going to take me 2 weeks, I would go and find something that had, 21 days or so. So here's 24 days out there. I could go there to that option. I go to my delta. I'm looking for 65 to 85. Well, I've got a couple of them. 67, 73, 77, and 81. But look at this. 0, 0, 0. Well, guess what? That's it. That's my only open interest of 100 or greater, and it's a lot greater. 13,000 is the number. Now, you notice there's no weekly next to this. That is because it's a monthly option. The reason these are all zeros is they were probably added. See, this is the 110. And then the other one that has open interest is the 105. They probably added the other ones recently, which is why there's no open interest. All right, so there you have it, ladies and gentlemen. I hope you got some good information on the basics here. We'll do some more options videos as well. You have a wonderful day, and I will see you all at our next video. Take care, folks. Make sure you come to wealthbuildershq.com. Check it out. There's a lot of free stuff on there as far as learning about the market, stocks, options, futures, forex, online business, and so forth. Take care, folks. Bye.